Welcome and thanks for joining this quick guide to bonds. On this slide, we introduce what bonds are: fixed income securities where investors lend money to governments or companies in exchange for regular interest and eventual repayment, helping finance projects and providing diversification and risk management for portfolios, and setting the stage for the topics we'll cover next. This slide looks at the main types of bonds you'll encounter, starting with government bonds, which are typically low risk, corporate bonds that offer higher yields with more credit risk, and municipal bonds that can provide tax advantages. The picture on the right hints at how different issuers and market conditions shape investor choices. Here we explain how bonds work by focusing on three core ideas: the bond's key features like coupon and principal, how interest payments and yield determine returns over time, and how maturity dates affect redemption and investor decisions, giving you a compact framework to understand bond mechanics. In this slide, we highlight why investors buy bonds. They deliver a steady income stream through regular interest, help diversify portfolios to reduce overall volatility, and generally carry lower risk compared to stocks, making them attractive for conservative or income-focused strategies. Now let's consider the risks tied to bonds. Interest rate changes can hurt bond prices, credit risk means issuers might default, and inflation can erode the real value of fixed interest payments. So understanding these factors is crucial before committing capital. Bond pricing is driven by several factors. Interest rates and credit quality influence market value. Yield to maturity gives a comprehensive return measure if you hold to redemption. And pricing models and yield curves help investors estimate fair value and spot opportunities. When buying bonds, you can purchase directly from issuers or use brokers, or access bond exposure through bond funds and ETFs for diversification and professional management. This slide also urges you to weigh costs, accessibility, and your own investment goals when choosing how to buy. Evaluating a bond involves checking credit ratings to assess default risk, reading bond covenants to understand issuer obligations and protections, and studying duration and convexity to gauge sensitivity to interest rate movements and potential price volatility. This slide explains the role bonds play in a portfolio. They are a tool for asset allocation that can stabilize returns, help balance risk, and return through their inverse relationship with equities, and serve as a counterweight to more volatile investments. Tax implications matter. Know the difference between taxable and tax-exempt bonds like municipal issues. Be aware that capital gains taxes can apply when selling at a profit. And remember that interest income is often taxable at federal and possibly state levels, affecting net returns. Global bond markets vary by size and structure, and this slide encourages you to explore major markets, consider currency effects on foreign bonds, and weigh the diversification benefits and risks of investing in emerging market debt. Economic indicators shape bond behaviour. Changes in interest rates drive yields and market dynamics. Inflation affects bond attractiveness and purchasing power, and different phases of the economic cycle influence bond performance and risk profiles. Here we outline common bond investment strategies. Buy and hold investors aim for income and price appreciation over time. Active managers seek to add value through trading and market timing, and laddering builds portfolios with staggered maturities to manage liquidity and interest rate risk. Bond market trends deserve attention. Monitor current yields and macro indicators to understand valuations. Watch for future trends that could reshape opportunities, and follow how central bank policy like rate changes or quantitative easing impacts market sentiment and prices. Ethical investing in bonds is growing, with socially responsible bonds funding education and community projects. green bonds financing renewable energy and sustainability, and impact investing targeting measurable social or environmental outcomes alongside financial returns. Case studies bring bond lessons to life. Looking at historical events and market disruptions helps extract practical insights, showing which strategies held up under stress and which lessons investors can apply to improve decision-making and risk management. This slide covers bond funds. Understand different fund types including government, municipal, and corporate bond funds. Weigh the advantages of diversification and professional management versus risks like interest rate sensitivity and credit exposure, and learn key metrics for fund evaluation. Behavioral finance matters when investing in bonds because emotions and cognitive biases like overconfidence or loss aversion can skew judgment. This slide explores how investor psychology affects pricing, risk assessment, and strategic choices in the bond market. For practical support, look to recommended books for deepening knowledge, websites, and tools that provide market data and calculators, and educational courses that build skills in bond analysis and portfolio construction to become a more informed investor. Comparing bonds to other assets helps clarify their role. Bonds typically offer more stability than stocks, more predictable income than real estate, and can act as a hedge versus commodities. So consider liquidity, income profile, and volatility when choosing between asset classes. Looking ahead, the future of bond investing may include shifts in interest rates, new bond products like digital and green bonds, and technology-driven changes in issuance and trading that improve access, transparency, and efficiency for investors. Regulation keeps bond markets orderly. Regulatory bodies set rules to protect investors and ensure fair trading. Key regulations govern issuance and reporting, and investors should stay compliant with requirements to avoid penalties and safeguard their holdings. In conclusion, remember the fundamentals. Bonds provide defined income and play a role in portfolio diversification. Ongoing education is vital to adapt strategies to changing markets, and disciplined analysis and risk management are essential for successful bond investing. Finally, use additional resources and references to keep learning. Explore further reading materials to deepen financial understanding. Leverage software tools for analysis and tracking, and visit reputable financial websites for up-to-date news and data to inform your bond decisions.